back to my YouTube channel. My name is John Samuel Smith, and today I'm going to be going over the basics, the fundamentals of the stock market. Today we're going to be talking about support and resistance. On the previous video, I went over cup and handle. That's why it's still showing up on there. But right now, what I want you guys to do is hit the subscribe button, hit the bell, and then give me a huge thumbs up so that I know that you guys are going to help me out in the future with some good likes and follows. All right, so let's go and get started with the support and resistance. So in the stock market, you have a cup and handle. So what a cup and handle is a support and resistance. It's a pattern. So it's a support and resistance pattern showing you exactly how the market is moving and which direction the market is going to be moving in going forward. So it's a good indicator. It's very, very reliable. It's not 100%, but most traders do use the cup and handle to figure out how the market is going to be moving. So with that, they use something called support and resistance, and I'm going to go over bullish and a bearish support and resistance and what that looks like. So I'm going to start out here. Let's just start here. Alright, so I just drew this, and this is representing the candlestick chart that you're going to be looking at. Alright, and then these are the levels you see here. So if this was a chart, this level here would be resistance level 1. So you have R1, you have support 1, so you got R1, S1, you got R2, it's kind of like a cap on the level of how many buyers are in the market at that given time. So let's say, for example, at resistance level 1, which is here, let's say, for example, at resistance level 1, it pulls back, and those buyers who refuse to buy any higher, they took their money back, and then it went down to a lower point, which would be considered the floor or the support level. So the support level here is going to be another trend line, which is going to have a support for how many buyers are willing to keep that money in the market. So it's kind of like a balancing act that's going on in the market. So you have a level that people are not willing to buy anymore, but a level where people are not willing to sell anymore within that price range. It could be for a particular stock. It could be for a particular currency if you're in the Forex markets. It could be for a lot of things in life. A lot of things it will work for. But today in particular, we're talking about the stock market. So I'm going to draw a trend line here. This is going to be your floor. So in the market, these trend lines, they go across, and that shows another support level for the market. So when R2 breaks through the trend or the support level for R1, it's like going through the ceiling. So that now you know that there's going to be a new level, a new ceiling. So knowing that there's going to be a new level or a new ceiling, going forward, you know that this right here, since R2 is higher than R1, R3 is going to be projected to be higher than R2. So it's going to be a bullish signal if you're looking into the markets. So then so those are new levels. So when you're looking at different indicators, it's going to help you understand exactly how the market is moving, and it's going to give you more confidence when you're trading or investing, because you know now what the levels are potentially going to be. So let's say, for example, this setup was, let's say this is $1.15. Let's say this is 120. Say this here is $1.10. This is, we'll do 105 for this. This is 105. All right. So as you have your support levels, you know when the trade happens that the resistance level is gonna when it draws back, it's gonna have a new support level as well. Well, it's not gonna go down to the previous low, but you know that it's gonna go down some. But you wanna make sure that you're getting ready for the buy as long as resistance 2 is higher than resistance 1. So you're gonna always wanna pay attention to where the resistance was before, so that you can make an accurate prediction or more accurate prediction than the previous. So that's gonna be for a bullish pattern. So once you see R2 go higher than R1, that's going to give you a bullish buy signal, and that's how you know you're going to be able to make more money on R3. So you're going to want to buy on the first blue candlestick at the end of R2. After R2 starts to pull back into the market, it's going to give you an opportunity to then buy into the market, and you'll be able to make more money through the bullish signal that is here on this chart. So that is for the bullish buy signal. And now we're going to erase this really quick, and we're going to go into the bearish